good morning, everyone, and thank you for joining us today for the investor presentation for PCF Bank, where they'll be covering their preliminary results. We're joined today by Scott Maybury, CEO of the group, who is going to talk us through the presentation. There'll be an opportunity for Q&A at the end, so please submit them throughout the presentation as we go along using the Q&A function within the Zoom controls. We are also recording this, so if you do want to watch it back later, it will be on our website. And as a reminder, we did publish forecasts at the end of last week, and you will also find them on our website. Otherwise, I will hand over to Scott.
Thank you. Thank you very much, Hannah. And hello, everybody, and thank you for taking the time this morning to listen to this presentation regarding PCF Bank's preliminary results for the year ended 30th of September. Just before we start on the presentation itself, I think it's probably key just to pull out what I think are the four main themes out of this year. And of course, for a year that's been so badly disrupted by the pandemic, of course, I think there's some common themes across all companies, but it's not just about the results, it's about how you respond in difficult times like this. So I think the first theme really is around our staff and our customers and looking after both. And I think from a staff point of view, yes, initially it's all about operational issues with the staff, but as this pandemic's and anyone who's an employer themselves will have been familiar with those issues. But as it's gone on, it's also been about the well-being of staff as well. This has been very protracted and certainly an event that most people hadn't experienced previously. And as far as customers go, you know, we really do mean it when we say we've kept excellent customer service. We haven't had a requirement for queuing systems on our phones. We haven't had a requirement for apologies on our website as to customer service levels. We haven't had to have any messaging around, please bear with us, it's been difficult. It's been pretty seamless, and I think anyone that's dealt with us, whether a saver or a borrower, has had a good experience. And when you consider the level of traffic through Forbearance, I think that's very credible. The second thing that I'll be talking about through the course of this presentation, as well as the markets, just to give you a feel for how the markets we're in have responded and how they're looking at the moment, and how we expect them to perhaps react in the future. And I think one of the strengths coming from that is really the diversification of our portfolio, which some areas have performed better than others. And I think that there is strength in that diversification. And some of that diversification has been in the last 2 years. So I think we can credit ourselves with having adopted a strategy of diversification over the last couple of years since becoming a bank. The portfolio is obviously an important part, and there's a number of things to discuss around the portfolio, whether that be the growth, whether or not that be the profitability coming from the portfolio, whether or not that be the tighter credit risk appetite that we've applied to our lending since the pandemic started, whether it be forbearance and how the collectability of the portfolio is performing. And of course, I think that also covers the all-important topic of impairment, IFRS 9, and the outlook and provisioning. And then I think the last thing, and we'll deal with this as well, is you know, how we take advantage once the UK starts to show signs of stability and recovery, and whether we're ready to change gear and step up our lending again and respond to the opportunities that are in the marketplace. So if we turn ourselves to the presentation, for anyone that doesn't know us, on the overview page, it sort of it actually provides our lending divisions. 2 of those we've been in for a long time. The diversification I spoke about is in Azul and property bridging. Our portfolio has grown to 434 million, and that's been slightly affected by the pandemic, of course, but I think we'll be slightly unique in a bank that we have shown good portfolio growth through the year, unlike most of the results that have come out thus far. Funded mainly by retail deposits, and as an SME lender, of course, we get access to the Bank of England's term funding scheme, which is base rate funding which can be used for any lending into the sole trader or SME market. Prime grain credits, we've been on this journey ever since we've accessed cheaper funding. It was a stated objective to move from a near prime funder to a prime funder once we got the banking license, but that's even more so now, and I think a very prudent move in the current environment. Doesn't mean we'll remain there, but and it's always under review, but I think quite a sensible lending approach. Profitability is down, but I think when you make adjustments for impairment of whether that be goodwill or whether that be impairment for potential credit losses in the future, the underlying profitability of the business model remains. Net interest margin has been squeezed slightly, as you can't have both. You can't move more prime and you can't maintain previous levels of net interest margin. I'm sure people will understand that. Significantly higher impairment charges, and I'll come on to that a little bit later. Also, impairment of goodwill needed to be done on the Azul acquisition. Azul had a period through the pandemic where, if you wanted really a snapshot of how a business can be affected through a crisis like COVID, Azul was one. Almost overnight, its business model came to a shuddering halt. Broadcast and media, TV and film production, sporting events, live events, all almost stopped overnight. So you have to look at that. You have to look at the potential for recovery, the timing of that recovery, and it was sensible to make an impairment against that. Although you will hear from me later on that we expect that business to have a sparkling future, and I'll give you some background around that. Forbearance at its peak, 34% of the portfolio had asked for some level of assistance. In some cases, that was just precautionary because people had heard forbearance was available, and it was a very sensible and conservative step for them to take. It's gradually decreased with people coming back to full payment, and as we report, that's under 7%. And we went into this crisis with the portfolio, with the balance sheet very strong, and it continues to be strong with good capital and liquidity and very proactive management in both those areas. So operational highlights on the next page. New business originations were basically flat on the year, and that's understandable with some of our markets struggling more than others, but we still maintain some portfolio growth, 28% up to a portfolio of 434 million. And I think that growth is important when you look at the cost to income ratio of a bank, the investment in the platform that we've put in place, and staff resource over the last 3 years. You can't reverse that on something unexpected like COVID. So it's good to be seeing our income actually keeping pace with our costs, and portfolio growth is an important part of that. And our choice to move more prime allowed us to continue growing. Our retail deposits have also increased. I've mentioned the UK term funding scheme. We have 60 million drawn against that. We can continue to draw against that. And that is our main source of funding at the moment. For obvious reasons, it's cheaper than retail deposits. Diversification has shone up in the case of property bridging finance, less so in the case of Azul, but Azul had an excellent year in 19, and we expect it to recover to full health in 22, 21 being partially affected in the first half by continuing difficulties around COVID. The loan book is now 79% prime. That's across the whole 434 million. Over 85% of the originations this year are in prime, and that's actually leaving us with a increasingly prime portfolio with a lower probability of default and cleaner credit profiles, which is a sensible positioning of the portfolio in this current climate. And we feel as though the impairment taken is a prudent and realistic approach to the provisioning required. Of course, IFRS 9 is trying to take a forward look. It's trying to predict what the probability of loss will be and what the potential for loss could be over a period of 12 to 24 months looking forward. And you need to be taking that snapshot, of course, at your balance date. So it's never easy to do, but you're reflecting on what the position was back at the 30th of September. So at that point in time, there was no vaccine talk, for example, and there was probably the thought that we would get some sort of conclusion to Brexit negotiations as well. Of course, vaccine talk has been positive since, Brexit probably less so. So I think you're going to see all banks IFRS 9 provisioning being quite volatile, depending on the point in time you're actually making that judgment. If we move on to the next page, which is for financial highlights, underlying profit, which is adding back the goodwill, was down significantly, but that's because of the impairment charge. Impairment charge was up almost fourfold from 2.2 million to 7.8 million. So a very large increase in provisions. And as I've said, this is a judgment on forward losses. So those losses haven't been realised. That provisioning is there for a deterioration of economic conditions and collectability conditions around our portfolio. Operating income increased by 19%, and the net interest margin, as I said, has come down as a result of becoming increasingly prime. And as we signal in the statement, we expect that to continue through the course of this year, and how far that we get further compression in net interest margin really depends on how long we continue to only lend into our prime markets before reviewing our strategy and reverting to having a mixture of near prime in there as well. Earnings per share and return on equity, of course, affected by the lower profitability, and a total capital ratio, which is very comfortable, of 19.5 million. And I've already mentioned the cost to income ratio staying flat in the year. If we move on to the new business volumes, I won't go over all these pages in detail. You've got a page on each of our divisions. I'll just highlight some of the themes that we're seeing. Consumer finance has had a good year. Motor finance has been robust. I've made announcements previously that there appears to be a slightly structural change across the UK, with people moving away from public transport and using vehicles. And of course, we have and remain being a used car lender. And I think people who require a second vehicle are more likely to look at used cars. And that's supported by the car retailing groups as well. If you read into their results, used car sales is the strongest part of their model. Business finance was down, and that is understandable, with small businesses not investing in business critical assets at the moment for obvious reasons. With uncertainty, you're going to see a fall in demand. And where businesses do need cash flow, they're tending to rely on the government support systems of CBILS and bounce back loans, which, unlike our product, which is linked to an asset, they're effectively a working capital solution for them, providing much greater flexibility for cash. So I think there is logic there in that. Azul, as I said, almost most of its markets being affected very early on in the crisis, and the recovery of that market will be very much dependent on those events and TV and film coming back. The strongest part of the year for all of those things, whether it be a live event or whether it be filming, TV or film, tends to be the longer daylight hours in summer. So we're not predicting any strong recovery over the winter months. And that's part of the reason for the slightly pessimistic view on the goodwill impairment. But what we are seeing is some recovery in the online so the on-demand streaming services, where there's a huge demand for content. So what we're talking about there is Amazon Prime, Netflix, and Disney Plus, and we're uniquely positioned to take advantage of their investment in the UK market. Disney Plus, for example, have taken a 10-year position on Pinewood Studios. They've locked everyone else out for 10 years. So they're businesses that are thriving in the UK, and there's a huge demand for content. They're subscriber services, so they can't pay, they're not going to get subscriptions if they play repeats, nor are they going to get advertising if they play repeats. So we've seen those markets starting to recover with some good deals, particularly for Disney Plus, but Netflix very strongly positioned as well, taking a 3-year contract with Shepperton Studios. So we do see some recovery, firstly in those markets, followed by the live events and more standard TV, documentary, mini-series returning next spring. Property bridging finance is an example of an area where we've seen real success in the new diversification, growing from a small base the previous year up to 60 million of originations in the year. And that success has been based on the fact that a number of non-bank lenders actually withdrew from the market very early in the crisis, and were able to build relationships and grow that quite strongly. So very pleased to have that within the stable this year, and very optimistic about its position moving forward as well. The next page really just emphasises the change between H1 and H2. Just H2 for us was completely covered by the disruption of COVID, our second half starting on the 1st of April. And you can see that Azul and business finance sharply down. Consumer motor was successful. And of course, we launched a new consumer motor proposition in the prime market very early in the year. So that's really supported our success in that market. And as I've already said, property bridging, very successful as well. The next couple of pages I wasn't going to go into in any great detail. You've got some more granular data on those markets, why we've succeeded or why they're slightly more difficult, and a little bit of detail about our market share and the size of those markets as well. So if I move on to the all-important page 13, which is forbearance, which I'm sure is in everybody's mind. The first requests we saw were really from Azul, and I've spoken about the sudden nature of the shutdown in that industry. But the other main areas that we saw some immediate effect was the coach and bus sector as well, which we are a lender into. We saw a constant increase in requests from customers during the first lockdown. In many cases, people just taking precautionary steps. It was well advertised by the FCA that forbearance was allowed, and clear guidance was given, particularly in the regulated market, as to the requirement to give forbearance. And we've seen a gradual reduction throughout summer. So at its peak in May, we had almost 140 million of our portfolio in some form of forbearance, where people have asked for assistance, and that's reduced to 23 million at the end of November, less than 7% of the portfolio. And those customers that have returned to full payment in nearly all cases, and in some of the more troubled sectors like coach and bus to a partial payment. And we're nursing some sectors like them and the taxi industry as well, just through what could continue to be a difficult winter. But as you can see from those statistics, that is still a small part of our book overall. Business finance division and Azul still show the highest levels of forbearance, and I don't think that would come as a surprise when you think about the industries they lend to and the difficulties in the SME and sole trader market. And there's a useful graph there just to show you business line by business line how that's come down over the period. If we move on to more cheery news, the achievements for 2020, our operating model's shown good resilience, whether that be the deployment of staff at home. We have almost 100% of our staff working remotely, or whether it be the profitability coming from the portfolio. We've seen growth in our motor finance through the automation of our prime proposition. That launched in January. That was well signposted in last year's results. It had excellent 3 months until COVID, and it is there still operating, and its full potential will be realised post-COVID when demand continues to pick up and when we broaden its use back into the near prime market, not just operating in the prime market. At the tightest point in the pandemic, we'd actually reduced our lending to our top 2 credit tiers and tightened our risk appetite right up. We've diversified the balance sheet through new property, bridging, finance, and you've seen the success of that. We've close capital and liquidity management has seen us maintain a comfortable surplus in our capital and also comfortable surpluses around our liquidity. And we've continued to invest and will continue to invest in our platform, ready for the recovery of the UK at some point through 21. It's not a case of sitting and waiting. It's a case of actually continuing to put the investment in our platform so that we are able to scale the business beyond where it is at the moment, just short of £500 million, onto being a business with a much bigger portfolio in the future. The future operating model on page 15, we're using this time of lower business activity. We're not transacting as many transactions as we were previously, to actually do an operational review of the business and actually look at our efficiencies, look at automation of processes, and look at the straight-through processing capabilities of the business, and use the time wisely so that when volumes and originations do pick up again, we're better placed to process them more efficiently. We use technology, of course, to support that scale and deliver those efficiencies. We'll deliver a new lending portal for our SME proposition in the calendar first quarter of next year. Many of the learnings from a similar exercise in consumer last year have been used in the SME lending, and that will give a much better customer journey for all our SME customers. And we also believe there's going to be market opportunities going forward through further diversification, and those opportunities could be through lower number of competitors in the marketplace, but it also may lead to some portfolio acquisition and consolidation in the marketplace as well. I think the next page, the investment case, I think if anything, difficult times like this year actually shows the strength of our model and helps to underpin the investment case in a financial stock like PCF Bank. We have contracted income on the portfolio, on the balance sheet, 69 million, and that provides a certainty on our operating income going forward. We have a management team that, before being a bank, was in financial services for in excess of 25 years experience in the founding directors. So we've seen these credit cycles and we've worked the business through these credit cycles successfully in the past. We have a banking license which gives us cheaper cost of funds, and in the case of our SME lending, access to government support funding at base rate. We also have robustness in the model that allows us to sustain growth, and I think all of these things highlighted there have been either true this year all we true looking forward. We have a small market share. We can continue and pick up growth. We have diversified income streams, which has been a strength this year, balance sheet strength, access to cheap funding, and by investing in our operating model, enhanced infrastructure to allow us to deliver operational gearing. So if I just finish off with the outlook, we're well positioned as a business. We're increasingly got a prime quality lending book, which is appropriate for the current times that we're in. We expect the impairment charge, should economic conditions not deteriorate in the short term. We expect the impairment charge to be lower in the next year. We feel as though the provisioning that we made under IFRS 9 has been appropriate for the economic conditions we're facing, whether that be unemployment in the future, whether that be business failure, or whether that be further economic contraction due to a no-deal Brexit conclusion. We have income and cash flow embedded in our loan book, so we can continue to be cash flow generative, and you've already heard me talk about the level of income already embedded in the balance sheet. Our medium-term target, which has been out there of a 750 million portfolio, has been put back. I would say 12 months. We can't fully estimate that time frame yet until we have some sort of clarity on the UK growing again. We'll remain a cautious lender. Our risk appetite is purely in the prime market, but that is under review. Historically, we're a near prime lender. We're good at that. We've been successful in that in the past, and we will move back and rebalance our portfolio at the appropriate time. Until we do expect a little bit more NIM compression, but we do continue to expect some level of portfolio growth, which I think is important as well. We'll invest in the business and we'll digitalize our processes under an operational review that I spoke about. We're being cautious about targets and objectives until we have full visibility. There has been a recent, the equity development note will give you some sort of feel, but I think numbers will be fast moving and we'll continue to review and probably change those numbers as and when we get clarity on the future. And you will see in the announcement that the dividend was actually held back at the final stage. We'll review that decision again at the interim stage. People may or may not remember whether you're an investee in PCF Bank. We did actually pay a dividend this year, back in April, one of the few banks to pay a dividend since the pandemic came on. So as we had paid one and other banks hadn't, we thought it was sensible just to reflect on both balance sheet strength and future growth in the UK economy before declaring and making a judgment on that. So I think with that, just to say, we're optimistic to the future. We can't give you exact timing as to when we'll return to our previous levels of growth, but we're full of optimism that as and when the UK responds and comes out of the position that it's currently in, we'll be well positioned to take advantage of those opportunities.
Thank you very much, Scott. A helpful and comprehensive overview. And we've got some questions coming in. I think the first one's pretty obvious given everything that's going on in the headlines at the moment, but perhaps you could expand a little more on how you are preparing the business for Brexit, a no-deal one. Well,
yeah. Of course, I think there's a lot of sectors, and of course, for example, we have a part of the portfolio in hauliers and freight companies. But what's unique about us is we're mainly based in UK, Wales, with a little bit of business in Scotland. So we're all UK. Supply chains could well be affected, but we're not really affected too much by trade negotiations. what really affects us for Brexit, and all we can really prepare ourselves for, and we've been doing that, is a sharp economic downturn. And I think best guesses are a 2% additional contraction next year if we have a no deal scenario. And how do we best protect ourselves against that? Having a good quality loan book, a loan book that in all economic circumstances presents us with good collectability. And I think by taking the loan book more and more prime over the last few years, and entirely prime over the last 6 months, we're putting ourselves in the best position to collect out our loan book and continue to deliver.
Another one here about a comment you made. Several non-bank competitors have withdrawn from the market due to liquidity issues in the early months of the pandemic. Can you expand on this and also comment about the competitive environment? Are you seeing it becoming more or less intense?
So that comment was specifically about property bridging finance, and it gave us our opportunity to actually increase our volumes in that marketplace. So there's a number of parties in that area, whether or not they're using debt funding, and that debt funding was less available, or whether they're using even some of the bigger players who are non-banks, who use warehouse facilities. A number of those warehouse facilities were put on hold. So we've seen them returning to the market. We're a small player in property bridging finance. We wrote 60 million of volume. We're hoping to and expecting to actually increase that in the current year. And what it's given us is a foot in the market. It's always easier to grow when you're a new player from a low base, but we were in a market that could have been affected. Our ambitions anyway could have been affected in its first full year if it hadn't been for the fact that a number of parties out there did give us some competitive advantage in the early months, and we've held on to that competitive advantage by building relationships. Across our other markets, I think while the government support schemes are around businesses, we're going to see SME lending continue to have a fairly low demand, but that will recover. Businesses will need to replace assets, and businesses will start investing again, and we've seen that in previous cycles. Azul, I've spoken at great length about the recovery timing for that market, and consumer motor continues to be robust, and we expect that to continue to show good growth, and as and when we will broaden our proposition back into the near prime market where we've always had some success.
I think perhaps then just expanding on the Azul point there, obviously I realise you talked around Pinewood and Shepperton and the long leases they've acquired there from streaming giants. But in terms of the near-term response once we came out of lockdown, did you see an immediate pickup then?
No, we didn't. What that business, and it's a broking business after all. It's a broking business that we're attracted to because of its niche markets, good quality assets that provide good collateral value. But the skills of that business has been in broking the C-bills and the bounce back loans, and that's where it's been holding itself up with fee income. But it's only been in the last month or two, Hannah, that we've actually seen some recovery in that space. And as I said, that's amongst the on-demand streaming giants, but we expect it to follow. Sporting events, we're starting to see a little bit of a return, but I think that's very cautious and it's very localized. But live events, of course, such as bands and other concert and indoor facilities are still not open. So that's all going to start to happen about next spring. So we're just looking for what we'd call a few large transactions to occur over the course of the next 3 to 4 months. And then we're very much hoping the course of this pandemic is that we can, over the course of this pandemic, it chimes in quite well with what is the strongest time of the year for the Azul subsidiary, which is the summer months and the longer daylight hours.
Well, let's hope you're right about the spring then.
For all of us, Hannah.
Absolutely. But yeah, moving across to car finance, do you see Moneybarn and Advantage Finance as competition?
Not particularly, not in the markets that we're operating in at the moment. People like S&U and Moneybarn. Previously, we used to compete in our near prime proposition with both those parties. They're experienced in that market. It's a market that they've solely operated in. I have read comments by both companies that they have tightened their credit appetite and are becoming more risk adverse through this crisis, but they still operate in that near prime space, whereas at the moment we're really operating purely in the prime space for the reasons I've given. So they're not direct competitors at this point in time. When we change our focus and broaden our risk appetite a little bit more, they will come more into play.
Okay. Well, I think then this question leads on because, as you say, you're focused on prime, but so how would you describe growing lending during a flash depression as conservative risk management?
Well, that's a good point, and you've got to assess all these things. We feel as though it's continued support of our customer base, whether that be existing customers or whether it be new customers with good and pristine credit histories, is a sensible way to continue to grow the business. But I take the question seriously. It's very important that when we do come out of this cycle, that people don't reflect on PCF Bank and say it was reckless in its lending at a time when it surely should have seen that the economy and its markets were under stress. So that's just about experience. It's just about being in these markets for a very, very long time in the case of SME lending and consumer motor. Understanding the markets well, having routes to market that are tried and tested with people that we trust, and understanding fully the credit risk and how to price properly for risk in those markets. In the case of property, which you could say, well, that's new. How much do we know that market? We've taken the decision there to have very conservative LTVs, and you'll see in the presentation the average LTV across our book is only 60%. So even allowing for the most pessimistic of movements in house prices, I think you would have to say that we're taking a very cautious approach there. And of course, we're also only lending against first charge residential property as well. So there's no second charge risk in there. Predominantly in that book at all. So we think that's a cautious approach to that market, and it's still a small part of our overall business, but been a successful diversification.
Well, going back onto the conservative theme then, is there any clawback mechanism in place if it turns out that your impairment charges look to have been overly generous?
Yes. Well, what you would see through IFRS 9 is an almost unraveling of the charge through the course of the next 12 months as the economic scenarios and the payment performance of the portfolio actually turns out to be better than it was actually forecast to be at the 30th of September. So, we're seeing it quarterly. I'm sure we're going to see when December's numbers come out. We take a live data feed from an independent forecaster, and that goes into the model. Key things for us are things like GDP, unemployment numbers, asset prices on used cars, house price, inflation or deflation, are key factors that go into that modelling. I'm sure when we see the December numbers, it's going to be a mixture, isn't it? I think vaccine talk will have improved GDP outlook compared with how it was compared with 30th of September numbers, but a no deal Brexit scenario is going to work the other way. And that's for those reasons, I think you're going to see very volatile numbers coming out of IFRS 9 over the course of the next 6 months. And where we're slightly different is we're very early in giving out our numbers. So there hasn't been that many people to compare us to. Close Brothers have a July year end, so they've also reported early, but really there's only been Paragon and Virgin who have September year ends, and they're not really a similar business model to us. They're predominantly, of course, residential and commercial mortgages, buy-to-let mortgages, which markets we're not in, and some unsecured credit card and personal loan debt as well, which is also an area that we're not in. So it's hard to get comparatives and a peer group, but I think we're going to get more of a feel as we move into the first quarter of next year with the big raft of 31 December people. And they must be wondering what their economic data feeds are going to be like when they have to cut their IFRS numbers on the 1st of January.
Well, let's take an optimistic approach to the last month of the year, and let's say we get some kind of a Brexit deal. Thinking about best use of capital, would you look towards, growing your loan book? Would you look at share buybacks, or would you look at acquisitions? I mean, one would imagine, particularly now that you have your banking license, that there is opportunity out there to acquire loan books where you can add accretive value at better rates. What do you think?
Yeah, certainly not by share buybacks at the moment. We're in a part of our growth cycle where we're going to remain in need of capital. We can look at capital light structures, and we will do that. And we're looking at a number of ways of making ourselves more capital efficient, and we will press on with those through the course of next year. But we are a capital intensive model in our early days of growth. Until you become a mature bank, you are likely to require capital. So how will we continue to grow the book? Our growth of our loan book has been in excess of 50% up till this year since we've become a bank. And as long as we do that in a prudent way, we would hope to return to those sort of growth numbers. Areas like property bridging are efficient. They have a lower risk weighting on their assets, so that's an efficient use of capital. But I agree with whoever asked that question. It's going to be a mixture of organic growth in our traditional areas and being opportunistic, I think, around market opportunity as well. So there will be portfolios to buy. I think there will be decisions by some people that we compete against to move out of some product lines, which may well suit us. A portfolio acquisition, which we've done many in our lifetime, is a great bolt-on in one of our existing areas where you can get immediate synergies and an uplift in return on equity. But I think also we've seen through diversification, you get a stronger balance sheet. So we'll also be looking for M&A opportunities as well to give us some additional income streams in the portfolio over the next 2 to 3 years.
Okay, we've all seen lots of digitization then through COVID, and you talk about developing online portals. Is the idea that these are for your intermediaries only, or are you going to use these as a sort of a direct offering and a way to cut out the middleman?
The new one in the first quarter of next year is purely for our intermediary market, for SMEs. There's less direct to business lending in that space. So we are focusing on the customer journey for our broker intermediaries. But we now have almost 12 months experience of our motor finance portal, which was launched in January. And we will look at piloting that on a direct consumer basis over the course of 21 for other products in some niche areas. So that will be new for us. It will be further diversification, and not just a diversification in product. It'll be a diversification as well in route to market. because we are very broker focused, other than our Azul portfolio. So it gives us strength in having an alternative route to market as well. And that will be a pilot that we will look at by using our increasing customer database, which is quoted in the presentation as almost being 30,000 customers now, who we will approach directly to offer alternative direct-to-consumer products, and just see whether or not there's an appetite there and how well our technology can be applied to those marketplaces.
Final one then. Obviously, we've published our forecasts. Just a question here asking if they were equivalent to the institutional brokers' forecast, which I guess, can you shine some light on where we sit in terms of consensus?
Well, at the moment, you're the first. You've got the privilege of being the first party to put out some market guidance on us. So, in the spirit of a new and thriving relationship with equity development, I've worked with your researchers to put out what we hope is a conservative position. We're going to put out some broker forecasts and a further note in the new year, initiating with Peel Hunt, who are our new brokers. We've recently moved from Panmure Gordon to Peel Hunt, and we're leaving that to January, really just because we thought it's a difficult time to be putting out forecasts. There's so much uncertainty around. I understand people want to hear from us and they want to hear where we think we're going, but I think there's a number of key economic decisions to be made over the course of the next month or two, which will require some fine-tuning of forecasts, and we may well be coming back to yourself, Hannah, and your analysts to actually give an update. So we thought it was useful to not put out too many all at once, and we'll continue to develop these over the course of the next 3 months.
Let us hope that fortune favours the brave. Well, listen, thank you to everyone for listening in today. Thank you, Scott, for taking us through the presentation and answering those questions so thoroughly. And let us all hope we get what we want over the next month. And we'll look forward to catching up with you in 6 months' time.
I look forward to it. And thank you, everyone, for your time, and wishing you all a better 2021.
Hear, hear. Bye-bye now.
Thank you.